Michael Burry, secret insider, just revealed a stock market crash like no other is coming soon. Every day, a new series of stock market crash warnings are making the headlines, as more and more experts point out the growing similarities between today and the run-up to the Wall Street crash of 1929. The outlook is bleak. While inflation is accelerating at alarming rates, on the other side of the ocean, the Chinese property market collapse is triggering a cascade of systemic failures that are starting to affect the global market. Some call it China's Lehman crisis, but others argue that it will be even bigger and it will compromise the global economic growth for years. Today we're going to talk all about what Michael Burry just revealed about the stock market crash coming soon. So watch the video till the end, because today's video is going to be the bomb. Welcome to Michael Burry Secrets, your daily dose of Michael Burry. If you're interested in everything around Burry, this is the place for you. Subscribe if you want to stay updated with all the Michael Burry secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end, and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. The real estate giant Evergrande itself recently warned about its growing financial difficulties. Evergrande alerted the global public that unprecedented problems are coming. The Chinese company is set to default on its debts, totaling a staggering $300 billion, which is likely to trigger a catastrophic financial chain reaction. Now, the latest analysis by experts this year have revealed worrying parallels between the events that led up to 1929 and today. According to Maury Klein's 2001 book, Rainbow's End, The Crash of 1929, several fundamentals of the previous crash can be applied today. In the book, he showed that 1 year before the crash, new listings on the New York Stock Exchange rose from 58 million shares in 1925 to 102 million in 1928. In 1929, the number of new listings hit record levels as a speculative frenzy swept across Wall Street. According to Will Daniel, an investment reporter at Business Insider, the book exposes startling similarities to today's euphoric markets. While there are many differences between the era of 1929 crash and the present day, the rise of new listings is a similarity that can't be denied, he wrote. On the other hand, there has also been a major increase in the number of inexperienced investors and speculators. The same thing happened leading up to 1929. Between 1928 and 1929, brokerage firms opened 599 new offices, and that has brought the total number of brokerage offices in New York to more than 1,600 just before the infamous Black Tuesday, more than double the number of operating firms in 1925. In 2021, a flood of new trading platforms emerged in app stores. Robinhood, E-Trade, and Fidelity are just a few examples, and they've been booming like never before. The Charles Schwab Corporation alone added an unprecedented number of 3.2 million new brokerage accounts just in the first quarter, much more than in all of 2020. Even Big Short investor Michael Burry has made a comeback to his Twitter account last week to compare the current options trading frenzy to the widespread speculation that sparked the Great Depression. Only this time, as Burry noted, the stakes are much higher. A year and a half after the 2020 stock market crash, expectations for a much sharper correction have never been higher. Market insiders are expecting a huge pullback before the year's end, and a number of indicators are signaling that another financial meltdown is looming on the horizon. Many major Wall Street players are now facing overwhelming uncertainty, and they've started to get ready for the worst-case scenario. More than 3/4 of respondents to a CNBC Delivering Alpha investor survey say now is the time to be very conservative in the stock market, and they highlighted the mounting risks of a crash. Respondents included at least 400 chief investment officers, equity strategists, portfolio managers, and contributors to the financial news outlet. In a fresh analysis published earlier this week, financial analyst Charles Hugh Smith described how the Fed's monetary policies have helped to create the biggest financial bubble in history, known as the everything bubble, which includes stocks, bonds, and housing. The expert says that now that liquidity has to stop propping up the markets, a massive bubble burst is just a matter of time. The problem here is all speculative bubbles pop, and so the central bank's inflation of a speculative everything bubble has backed the entire economy into a corner, from which there's no escape. Either the bubble must keep inflating to ever dizzier heights of delusion and risk, or the bubble pops and lays waste to all the phantom wealth, Smith noted. With all this in mind, are we really crazy enough to believe that this bubble will be supported by artificial money forever? Are we really crazy enough to believe that creating trillions of dollars out of thin air and then dumping all this money into assets that don't increase in utility but only in perceived value is a sustainable and solid foundation for our economy? We all know better than that. A huge stock market crash is fast approaching, and people need to run for the exits before an economic disaster is finally here. Burry, in some way, is saying he is the financial version of this priestess. He's freely giving out warnings on his Twitter account, but not too many people are paying attention. They're just enjoying the short-term returns that they've had. But let's see who wins in the long term. So I want to dig a bit further into something of the things that he's saying and what we need to watch out for as investors. First of all, we've got to talk about all these hype groups that we've seen on Reddit, on YouTube, and across the internet. These hype groups promote certain stocks, generally high-growth, risky ones, and a bunch of short-term money gets plowed into them. For example, the recent saga that we've seen on Wall Street Bets, with GameStop, with AMC, and all the other ones. We saw these stocks get out of control in terms of price, and people weren't afraid to throw their stimulus checks into them. Were they researching the fundamentals of these stocks? Most of course no. Did they understand the risk with these stocks? Most of course didn't. They were trying to make short-term, quick money. Michael Burry, who actually invested in GameStop when it was cheap, was not happy with all of this so-called uneducated money going into GameStop. He said, "If I put GME on your radar, and you did well, I'm genuinely happy for you. However, what's going on now, there should be legal and regulatory repercussions. This is unnatural, insane, and dangerous. And one of the reasons for this is just because there's so much free money floating around. We've seen the new $1.9 billion in stimulus checks come through. We've seen the Fed keep interest rates to pretty much all-time lows. This free money, a lot of it is entering the stock market, and a lot of it is entering these so-called meme stocks. Michael Burry clearly doesn't think that it's natural or sustainable, and I tend to agree with him on this point. The next thing that Burry talks about that is inflating stock prices is all of this passive investing. As he said, passive investing's IQ drain and #stonks group hype add to the danger. He said a while ago that index fund inflows are now distorting prices for stocks and bonds in much the same way that CDO purchases did for subprime mortgages more than a decade ago. The flows will reverse at some point, and it will be ugly when they do. Burry mentioned that central banks in Basel III have more or less removed price discovery from the credit markets, meaning risk does not have an accurate pricing mechanism in interest rates anymore. And now passive investing has removed price discovery from the equity markets. The simple theses and the models that get people into sectors, factors, indices, or ETFs in mutual funds mimicking those strategies, these do not require the security level analysis that is required for true price discovery. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Michael Burry Secrets. Bye!